Before handing over to Andrea, I would like to spend 10 minutes considering some key trends in global regulatory banking practice since 2007 and their impact on Guernsey. The bailiwick is an international financial centre, and regulation is therefore subject to international norms. This is nowhere more so than in banking, where the bailiwick acts as an entirely host regime. So how have international regulatory developments affected the bailiwick recently? Now, in some areas, we have been more or less unaffected. Bonus constraint, trading book reforms, FX and interest rate market issues have all passed us by, as they have limited relevance to the business model of banking in Guernsey. And in other areas, the Commission itself has taken care to apply a proportionate and limited response. For example, our recent stress test was far simpler than that applied in some other regimes. We remain wary of detailed model validation, and our rulebook remains relatively slim. However, certain international developments have materially affected Guernsey banks, and this journey is far from over. Just to give you an example of this, whereas Basel II represented a defined set of requirements to be implemented, Basel III has become a movable feast where change has become almost permanent. Indeed, it is sometimes difficult to predict where Basel III will go next, however well connected we may be. This is not least as the Basel Committee, which is more like a regulatory body, now operates under the aegis of the Financial Stability Board, which is more sensitive to wider considerations. So one key regulatory result of the crisis was the demand for more and better quality capital. In terms of the quality of capital, this has had little effect in Guernsey, as capital here has always been almost entirely Tier 1, and this will remain the case. In terms of quantity, Guernsey banks have generally always had lots of capital, not least for large exposure reasons. This has traditionally made our ICAP discussions with banks more an exercise in risk identification than capital setting per se, as the bank has always had much more capital than necessary for regulatory purposes. However, since 2007, several home governments have made it easier to repatriate overseas capital. Home regulators are increasingly demanding more capital for the home bank, especially under the single point of entry model, and some local banks here are holding larger credit books, in part due to upstreaming issues. With local capital less ubiquitous than before, this may in the future bring more edge to the question of how much capital Guernsey banks need. It is in this context that the Crown dependency regulators have been considering the application of Basel III capital standards, including the leverage ratio, to the CDs, the Crown dependencies. And several Guernsey banks this year have acknowledged that ICGs can go up as well as down, sometimes with encouragement from the Commission. Whilst, therefore, Guernsey banks remain well capitalised and will remain so, capital may emerge as more of a discussion point between the Commission and the industry than before. This, of course, in the context of effective risk management, is no bad thing. It is, however, a change brought about by post-2007 economic and regulatory factors, and an example of where global trends are affecting the bailiwick. The 2007 crisis began as one of liquidity. Since 2007, there has therefore been more an emphasis on a stock as opposed to a mismatch approach to liquidity. The Commission moved early here, and its 2009 liquidity policy includes a stock approach. So far, this has not posed too much difficulty for Guernsey banks, especially when they have already held a stock of assets. However, we have not yet implemented Basel III, so we cannot yet be sure about the full implications for Guernsey of the Basel III stock approach. This will emerge as we work with the other CDs on a common approach over the next 2 years or so. Another lesson of the 2007 crisis was that interbank and sovereign risk had been underestimated. This was reflected when this year the Commission revised its large exposure policy, something long overdue as this had been written in the 1990s. The new policy has required for smaller banks a diversification in interbank deposits. The new policy is also leading to a rundown in some larger non-bank exposures. The new policy has not signalled any change in the Commission's approach to parental counterparty risk, that's upstreaming, which the Commission recognises as part of the business model. Despite this, there will continue to be a business impact here for Guernsey banks, insofar as home regulators regard subsidiary upstreaming for liquidity purposes as volatile wholesale rather than secure retail funding. This has already had a major impact on the attractiveness of Guernsey for UK banks' subsidiaries, for instance, and remains an issue. Again, this is a change brought about by outside factors. Since 2007, many regulators are developing new approaches to bail-in and to recovery and resolution, part of which is including a bolstering up of local compensation schemes so as to reduce the risk to the public purse and improve depositor confidence. This is also linked in some jurisdictions with ring-fencing of retail deposits. Let me call this the resolution question. Comparability here represents a challenge to Guernsey due to the size of its banking industry compared to its GDP and to the fact that it's a host regime. A complicating factor is that the world has still not yet worked out how to deal with cross-border resolution. Quite how the bailiwick, and in particular its retail banking sector, which is so closely connected with the UK, will adjust in this new world remains unclear. This is something that the Commission is closely considering. For example, the revision of law's discussion paper aims to make it easier for information sharing to take place between home and host regulators for resolution purposes. Nevertheless, the resolution debate and how the bailiwick might best respond to this remains unclear, and it's another area where Guernsey will have to adapt to global change. One area that banks across the globes have also had to contend more than before with is conduct risk, reflecting in part general dissatisfaction with the quality of some banking services. PPI compensation has taken place in Guernsey, with 3 of the 4 large clearing banks possessing insurance intermediary licenses. Some banks have also been touched with the work undertaken by the Commission on sales advice around long-term insurance products. Banks in Guernsey will also need to work with a new Channel Island Ombudsman from next year. All of this is in line with a greater global focus on conduct. Incidentally, if you allow me to put financial crime mitigation under the general heading of conduct, bailiwick banks are continually obliged to up their game in response to tougher international standards and oversight. Although it's my impression that local banks have generally responded well in this respect. Again, this indicates a continuing need to respond to international requirements. The 2007 crisis has also led regulators to consider their own approach to regulation. They now look more at high-level business plans and are more inclined to challenge boards. I would like to think that we always did that in Guernsey, but there can be no doubt that our new risk-based approach through PRISM formally mandates such an approach and embeds it in formal processes. As you can imagine, it is no small task for the Commission to keep abreast of all these developments. However, our membership of the Group of International Finance Centre Supervisors and our informal links with home regulators will help. To conclude, Guernsey is subject to global regulatory and political trends beyond its ability to control. Some of these trends will require little or no change. Others will require a lot of change. The trick is to be aware of what is on the menu and to ensure that consequent change takes place in as pragmatic a manner as possible in Guernsey. Thank you.
Okay, thank you, Jeremy, and a very good morning to you, ladies and gentlemen. For those of you that don't know me, I'm Andrea Sarchet-Luff, and at the moment I'm the Acting Deputy Director for the banking team in the division. I was appointed to that role in August to cover an internal secondment, so I will be returning to my normal role as an Assistant Director in the banking team just a little before Christmas. Now, in his introduction, Jeremy described how key trends in global regulatory banking practice are beginning to impact on Guernsey in some areas. I'd like to start my session by considering some other external challenges that have already impacted on or have the potential to impact on our local banking sector. There are a number of challenges originating outside Guernsey that the Commission is aware of. We remain alert to the difficult and seemingly unending low interest rate environment that banks are currently struggling with, and the subsequent challenges to profitability and potentially even business model. This has recently been exacerbated by the ECB cutting its benchmark interest rate to a new low of 0.05% in September 2014. Local banks have not been materially impacted by the mis-selling problems of PPI and the interest rate hedging products, but there has nevertheless been the cost of establishing a sales review methodology and undertaking those reviews, despite the relatively low volumes of sales conducted in Guernsey. Lending in respect of high-end London property is part of the business model for a number of banks, and particularly our private banks here. Conservative loan-to-value levels mean that credit risk across the sector is relatively moderate in the event of a significant fall in property values. However, two recent moves by the UK authorities to increase tax take may possibly have an effect on local bank lending in respect of high-end UK property. The first of these is the proposal to bring non-resident individuals, trustees and partners within the capital gains regime for gains on UK property with effect from April 2015. The second was a surprise announcement by HMRC in August 2014 that it had changed its position on the taxation of non-DOMs who use foreign assets as collateral to finance purchases in the UK. The position is that these assets will now be classed as transfers of wealth into the UK and are therefore taxable both for existing homeowners and new buyers. When I was writing this speech, I had written that it was too early to tell yet how these two moves might impact on the demand for high-end London property, but anecdotally, we were speaking to a bank only last week which believes it is starting to see an impact on demand for those very, very high-value properties. Politicians and the media in other jurisdictions continue to focus on tax avoidance and on small financial centres in particular. And whilst problems in the Eurozone persist, this scrutiny is not likely to decrease. There is a cost, not only for those banks that suddenly find themselves mentioned in national newspaper articles, but more generally in terms of senior management time spent explaining to parent banks the context of media coverage and its relevance, or lack thereof, to the operation in Guernsey. I'd like to turn now to the Guernsey banking sector and have a look at the trends over the past year. And the slides I'm going to be using here have got the data up to and including the September 2014 BSL2 return. So the number of banking licensees had reduced to 30 during 2014, but we were very pleased to be able to do something that has become fairly unusual in the last few years, and that was to issue a new banking license to a branch that will become operational early next year. It is generally the smaller banks that have closed due to group reorganisation during this extended period of low interest rates and deleveraging. But as Jeremy mentioned, we've also seen some Guernsey subsidiaries surrender over the past few years because upstreamed funding is no longer regarded as secure retail funding. Since our last industry presentation in December 2013, the trend of falling numbers of staff employed in the Guernsey banking sector appears to have stabilised, and it currently stands at around 1,659 full and part-time staff. The island has benefited this year from new business arising from group acquisitions. Anecdotally, we are aware that there also appears to be a shortage of client relationship managers, which has the potential to push those staffing figures up a little further. Total assets held by Guernsey banks continues to fall, and it currently stands at 107 billion, albeit the last quarter in September did see a 5 billion increase. As you can see, the reduction in Swiss fiduciary deposits as a result of the low interest rate environment is a key trend. But we've also seen some chunky outflows as banks continue to consolidate or reorganise their operations. Reflective of the local trend, the global trend, the capital held per subsidiary bank has continued to increase, although 2013 saw a decrease due to the repatriation of capital by way of dividend by a number of banks. Jeremy has alluded to the pressure on local capital from the centre, but conversely, we're also seeing some banks paying smaller dividends in order to retain capital for large exposure purposes. Bear in mind that this chart doesn't include a number of dividend payments that we anticipate will be made during the final quarter of this year, which will have the effect of reducing that 136 million average down a little bit. I'd like to talk a bit about minimum regulatory capital, which those subsidiaries amongst you will recognise as the individual capital guidance figure, or ICG. When John Dunford was speaking at this event last year, he observed that he had yet to see an ICAP submission that recommended increasing the ICG. Well, it has been a little different this year, however, and we have seen some ICAPs that have resulted in an increased ICG. In some cases, this has been because a contraction in the balance sheet has reduced the Pillar 1 charge, which in turn tends to inflate the ICG number. But we're now into our fourth iteration of the ICAP, and banks are becoming increasingly more comfortable about calculating Pillar 2 charges direct or finding a reasonable proxy. The Commission wants to see appropriate ICG levels, and nobody here is going to die of shock at that admission. And in some cases, we have increased the ICG beyond that suggested by the individual bank. Why is that? Well, we have the higher capital levels required by home regulators that Jeremy alluded to at the back of our mind, and our approach has been to raise capital requirements in an incremental way. Additionally, on occasion, we have been able to suggest risks not previously considered by a bank, because of course we have the advantage of knowing what other banks have considered to be material risks requiring a capital add-on. Just to illustrate what I've been saying by way of something visual, this slide is the split of ICGs as at the end of 2013 versus the split as at today's date. And you can see that the trend, with the exception of the very highest level of ICG, which is shown in green, has been to increase in the incremental way that I've described. So what has the division been doing over the past year? Participation in colleges of supervisors continues to be an essential element in our supervisory programme, and the Commission has attended 6 of these colleges during 2014. They help us to better understand the strategy and the capital and liquidity strength of parent banks, and they assist us in understanding the risks or the issues faced by other banks in the groups. Our impression thus far has been that our own licensees are relatively problem-free compared to some other group banks that we hear of in colleges. The colleges are also extremely useful opportunities to build good relationships with home and host supervisors alike. Whilst not facilitating such an in-depth analysis as colleges, attendance at bilateral meetings with home supervisors gives us an insight into the strengths and weaknesses of the parents of our own licensed banks, and enables and encourages constructive dialogue. And the Commission has attended several such bilateral meetings during 2014. We have held 5 tri-party meetings during the year with the regulatory commissions of the Isle of Man and Jersey to ensure a consistent approach on such matters as Basel III capital requirements, the leverage ratio, domestic systemically important banks, and UK banking reform. On this latter subject, the future structure of Guernsey retail banking operations in the wake of UK banking reform remains uncertain. The Commission will continue to monitor the impact of developments on the jurisdiction with respect to the continuity of banking services and the safety of Guernsey deposits. There is a periodic need for supervisory stress testing to assess risk sensitivity across the sector and to identify any emerging sources of risk. Over the summer of this year, the subsidiary banks have been required to undertake a series of stress tests, including single-factor stress tests and a reverse stress test. Thinking the unthinkable around extreme events leading to institutional failure is the foundation of reverse stress testing. But what has been interesting has been the extent to which some banks still struggle to cope with the reverse stress test concept of starting with a capital breach and then working backwards to identify a scenario that could have caused it. The tendency of some banks was to start from the other end of the problem, identify a scenario, and then see what impact it might have on capital. The Commission will be publishing a summary of the findings from the stress test exercise shortly, but this will not identify individual banks. Since 2001, Guernsey banks have been submitting the quarterly Lock 1 locational statistics return to the Commission, following a request for such information from the Bank of International Settlements, or the BIS. The Commission aggregates this data for onward encrypted submission to the BIS on a quarterly basis. At the end of 2013, the BIS issued requirements for Stage 2 enhancements that called for a considerable increase in the granularity of this locational data. It is testament to the hard work of all of you in each bank that are responsible for preparing these statistics in the Stage 2 reporting, because that reporting has not only been tested, but it is now live. That has enabled Guernsey to be in the vanguard of jurisdictions successfully meeting the BIS's requirements. And believe me, there are a lot of other jurisdictions out there who are still struggling with the testing phase. So a big thank you to all of you and to colleagues who might not be here today who have worked on that from us. Thank you very much indeed. Now, the last bullet on this slide is a little subject in itself, so I'm going to spend a little more time talking about policy. The new large exposure regime went live on the 1st of July of this year, with exposures existing as at that effective date being grandfathered through. The introduction of stricter collateral requirements for client exposures in excess of 25% of capital has not produced any material difficulties, largely because existing client exposures have been grandfathered through, but also because the majority of the banks had already walked away from doing big-ticket client exposures before the revised regime came into force. Placing limits on interbank exposures has undoubtedly been the most unpopular part of the new regime, but not to have done so would have flown in the face of the international practice which was implemented in the wake of the financial crisis. Again, the impact is mixed. For some banks, the limits on interbank exposures were in excess of internal limits that the banks had set for themselves. For other smaller banks, being forced to diversify interbank exposures amongst additional counterparties has been painful, despite the fact that existing interbank exposures are also grandfathered through to expiry. We're now in the process of agreeing upstreaming limits with individual subsidiary banks that will come into effect from the 1st of January 2015, and we don't expect those limits to have a negative impact on banks. The process has been more complex this year because of the inclusion of off-balance sheet liabilities for the very first time, and I think it's fair to say that we have some lessons to learn for next year's process. Considerable time and effort has been expended by the Crown dependencies in developing a consistent approach to Basel III, and several joint papers have been issued. The first was a general discussion paper issued in September 2012, and this has been followed up with further, more specific discussion papers on capital adequacy, on domestically systemically important banks, and on the leverage ratio. The objective remains to achieve consistent application to the extent practical across the Crown dependencies. By necessity, however, owing to local implementation process, consultation papers must be issued individually by each jurisdiction, and the proposals therein may reflect slight differences in local reporting format. The Commission plans to issue a consultation paper based on the proposals in the capital adequacy discussion paper in early 2015, with a view to implementation at the beginning of 2016. Other elements of a Basel III consistent regime will follow thereafter, with an overall goal of implementation before the end of 2019. The issue of a discussion paper on revisions to regulatory minimum liquidity standards is anticipated next year. The Basel core principles for effective banking supervision changed in September 2012 to include a brand new principle on corporate governance, and also to focus more on the implementation of the principles. A theme of financial stability, whilst not a core principle in itself, also runs throughout. A subtle change in the wording of the principles now puts a more proactive burden on the Commission by requiring us to determine that X has happened, rather than being merely satisfied that X has happened. Given that Guernsey as a jurisdiction is assessed against these principles, the Commission has developed an action plan to ensure that any gaps are remediated in a proportionate manner. The action needed to close the gaps varies. Some can be addressed through a simple change in Commission procedures, but at the other end of the scale, some changes to the supervisory legislation will be needed. These changes have been included in the Revision of Laws project, and a discussion paper on that project is available on our website at the moment. One of the gaps being addressed is through the exercise that we have asked you all to complete this year in tying the verification of prudential return into the financial year end, so that any significant differences between valuations used for financial reporting purposes and valuations used for regulatory reporting purposes can be identified. And again, I'd like to thank you all for your cooperation in this rather unusual exercise. One of the biggest tasks for the banking team this year has been getting to grips with a new way of supervising banking licensees. We mentioned at last year's industry presentation that the Commission would be transitioning to a new impact and risk-based supervisory framework in 2014. This framework is called PRISM, and we are now underway with it. Only a very few of the banks here will have experienced the revised supervisory approach thus far, however. So let me set out the objectives of the revised framework and what's different about it. Risk-based supervision starts with the premise that not all firms are equally important to the economy, and that a regulator can deliver most value through focusing its energies and finite resources on the firms that pose the most significant risks and present the greatest threat to financial stability and consumers. Our first step under PRISM, therefore, has been to classify all of our firms into 4 categories of impact: high, medium, low, and low. Impact indicates the degree of damage a firm could cause to its consumers, to the financial system in the bailiwick and elsewhere, to the bailiwick economy, and to the public, were it to fail, or to engage in persistently poor conduct. Our engagement with a firm is then driven by its impact level. So those classified as high impact can expect to see the Commission much more regularly than before. Conversely, firms having the lowest impact level will engage with the Commission on a trigger event basis only, or through participation in thematic reviews, rather than having regular contact. Having raised your hopes, I now have to tell you that none of the banks have been rated as low impact, so I'm afraid you will still get to see us on a regular basis. So what's new about banking supervision under PRISM? Well, the cycle of engagement will be very different to the model that you have been used to thus far, and it's existed for many years. So, for example, branches will no longer have an annual prudential meeting going forward, and similarly, we won't be asking all subsidiaries to submit an ICAP to us quite as regularly as before. PRISM requires a new set of engagement tasks, with greater emphasis on governance, risk management, and business model. We will now be meeting on a rolling basis with senior management, with key compliance and risk staff, and with non-executive directors. Separate from the cycle of these meetings will be the set-piece engagement task, if you like, and it's called the full risk assessment. This includes a substantial on-site element to consider probability risk, and will take place roughly every year for a high-impact firm, about every 3 years for a medium-high impact firm, and about every 5 years for a medium-low impact firm. PRISM requires supervisors to consider the level of risk in each of 11 different areas, which are referred to as probability risks, and here they are. PRISM imposes the discipline of having to consider and articulate conduct risk and environmental risk directly, whereas previously in our supervision of a firm, we may have considered these 2 areas rather more obliquely. Environmental risk, by the way, is about the risks arising from an operating environment of a firm, perhaps both generated internationally or domestically. So some of the challenges I spoke about earlier in relation to the low interest rate environment or to the political and media scrutiny would fit into the category of environmental risk. The only one of the 11 risks that sits outside the purview of the banking team is financial crime risk, which is assessed by the Commission's Financial Crime Supervision and Policy Division. That division determines the cycle of visits to licensees, and it keeps the banking team informed of visit findings and any remedial action required. That's important for the banking team because shortcomings in financial crime arrangements may well have implications for things like strategy and business model risk or governance risk, for example. From our periodic engagement tasks, and in particular our full risk assessment visits, we will be able to form a view as to the likelihood of a problem occurring in a particular risk area. The view on the level of risk requires the supervisory team to use their judgment. Because there is an element of judgment involved, the conclusions that supervisors come to about the level of risk are now subject to internal challenge at cross-commission governance panels or risk governance panels. It is the job of these panels to ensure that the conclusions reached and any outcomes are consistent and proportionate. Where a probability risk is considered to be too high, the Commission will ask a licensee to reduce the level through a risk mitigation plan. And once this risk mitigation plan has been completed, the supervisory team will assess the probability risk again. So that's the way we will be supervising banks from now on. What else is new next year? We wrote to all subsidiaries in March 2014 explaining that with the advent of PRISM and the need to consider the 11 risk categories that I've just showed you, the scope of the current ICAP process would be extended, and licensees would be asked to provide, in addition to the ICAP document, additional information regarding control framework, governance structure, and risk management process. And we refer to this bundle of documents in the process as the ICAP Plus. We're now coming towards the end of completing our first ICAP Plus, which allows us to view the bank's conclusions on capital in the context of the 11 probability risk areas. One plea that I would make is that despite the additional information required by the ICAP Plus process, the Commission still needs to understand from the ICAP document itself how a subsidiary has arrived at its capital figures. So however you got there, whether it's a calculation, a model, a stress test, we need to know how it works. We need to know what values you put into it, and we need to know why you chose those particular values. If it's a proxy figure, because there isn't an easy way to calculate an appropriate amount of capital, please highlight that, please say so. I would also ask that all ICAP documents include an executive summary clearly setting out the Pillar 1 and Pillar 2 charges. Those steps will help us enormously in cutting down the raft of ICAP queries that we currently come back to you on. In the light of PRISM, we've been looking at how we might streamline certain tasks. All banks undertake the annual Section 36C review as required by the Banking Supervision Law, and there are no plans to remove that requirement. However, the Commission has always wanted to see a copy of the annual review, which means completing a pro forma in some detail to explain how the bank complies with each section of 36C. Going forward, it seemed to us that an annual self-certification with an explanation required only where a bank had discovered shortcomings in its approach would reduce the burden on banks. That got us thinking about other possible areas for self-certification. All banks are issued with a standard set of license conditions at the point that they are licensed. But as that point of licensing recedes into the past, so does the institutional memory that these license conditions actually exist. An annual confirmation that license conditions have been complied with would be a useful memory jogger and a good governance tool. Finally, there are two areas that apply purely to subsidiaries. The first is a requirement to conduct annual liquidity stress testing, and the second is a confirmation that the board has reviewed the ICAP regularly and determined that the level of capital is still adequate for the risk profile of the business. Both of these requirements could also be subject to a self-certification. The Commission proposes, therefore, that from 2015 onwards, banks would submit one annual compliance form to confirm that the requirements that I've just outlined have been completed. Rather than automatically ask for additional documentation when this confirmation is submitted, the Commission would ask to see evidence as part of its next PRISM-related full risk assessment of the bank, unless, of course, there was something on that annual compliance form that gave the Commission cause for concern. That annual compliance form is nearly ready, so we'll be rolling that out to you along with some guidance before Christmas. Well, that concludes the presentation from the banking team, and on behalf of Jeremy and myself, I would like to thank you for taking the time out to come along and listen to us this morning. We'll now be very happy to answer any questions that you might have. Thank you.